Hi, and welcome to this week's episode of Money with Alpha. This week, I'm going to be talking about investing. It's something that I think is still a little bit of a black hole for a lot of people. It's a lack of understanding. And even where there's a certain amount of understanding, there's also this fear about, oh, well, what if I get in at the height of the market and things drop? Or what if I put my money in the wrong thing? Or I don't know what to put my money in because there's so many choices. Like, what do I do? So I thought I would spend this episode going through what I do and how I've come to be at peace, I suppose, with what I do, because I have a tendency to go down these like research rabbit holes and kind of question and go, is this the right thing? And like a lot of us, we don't want to, we've worked hard for the money that we have. We don't want to like lose it. And sometimes investing can feel a little bit like gambling, I suppose. But it doesn't have to be. And there's lots of different ways to do it. And there's no one right way. Investing is just something that we all should do, but how you do it, there are still choices that you can make, and there's things to be aware of as well. And that's also what I'm going to go through, just kind of play you through my thinking process and the research that I've done and how I've come to make the decisions that I've made, any changes that I've made over time, and what I'm currently doing and what I plan to continue doing, just so that you can kind of hear a real person's journey and take. And even though I'm a money person, I'm not I haven't come from a financial markets background. I've come more from an accounting background and sort of worked in like sort of data analysis, financial analysis kinds of things, that not necessarily in investing. So I've had to figure this out myself, is basically what I'm saying. And I've done this by looking and researching and listening and reading and talking to people and going to conferences and going to seminars and things like that as well. So, and there's in a previous episode, I've sort of talked about the kind of rabbit hole I dived into last year, and where I ended up as a result of that. But before I dive into all of that, I'll just sort of go through largely the areas I'm going to talk about today. The first one is looking at the difference between income and capital return, because I think they often get confused or blended. Risk profile and what that is, and how you can start to consider that for yourself. What diversification actually means. Then how do you build a portfolio for you based on that and based on everything else prior to that as well, like your risk profile. And then timing. And timing is one of the biggest ones that we try and manage when we have very little influence over anything except what we are physically doing. So I guess where this all really kicked off was, I mean, and we don't necessarily think about this a lot when we're younger because we don't have any money to do anything with. These days, however, even just micro amounts, which is why there's micro investing, makes a big difference. Like I still remember when I was growing up and the idea of investing just seemed so like out of reach. You needed a minimum of $50,000 to invest in like one thing. Then you had to take on debt to buy a property. And did you buy a home first or a rental property first? And it was just so much bigger and heavier and felt so much more significant. And the impact of failing felt heavier, as well, because there was just so much more money at stake. The playing field has changed quite a lot. There's a lot of things now that as retail investors, which is just everyday people, like you and me, we can get access to that we never used to be able to before. And I mean, even though ETFs have been around since the 70s, they haven't necessarily been as easily accessible and available to individuals. And even then, you used to have to go through a broker to trade or to buy them. Or even if when the platform started to come out, you could buy them yourself, there were still platform fees. And a lot of those things have fallen away. Micro investing has really changed the playing field. And that's been maybe almost a decade, I suppose, that we've had access to micro investing in Australia. I was rather unusually an early adopter with micro investing. I'm not normally an early adopter of anything, just FYI. I'm a bit more of a conservative observer who likes to sit back and see how things play out before I dive in. But micro investing just felt like, oh my goodness, I just need to get started. I want to see what this is about. How does this work? Like I literally cents on the dollar. How is this? Because the concept of pooled investing, which is a lot of what micro investing relies on, it's not something we're very exposed to or familiar with in Australia. But it's becoming more and more relevant and more acceptable because everything is just so much more expensive as well, especially in the property space. So being able to just buy even a commercial property as an individual, even with like finance backing, has become almost prohibitive. So you do get a lot of, pooled investments and syndicates, they're called as well in places like in the United States. And they're, they might sound a bit dodgy, like a syndicate. You're like, how does that work? But there are legitimate ones. Obviously, there are those that aren't. So you do have to be careful. But then now there's also people can get access to the private credit space. So it really just depends. So before I dive into too much of the how and the what, I'll explain a little bit more about what I'm talking about. So the first thing I want to talk about is income and capital in terms of returns. So a lot of the time when we hear returns, like a percentage return, it's purely the capital side that's being spoken about. Sometimes it might be an incorporate, like it might be income and capital together. But when they're like, oh, this index has gone up this and this many points, or there was this and this return when I bought and sold, most people are talking about just the pure capital. Like you say you bought it for $5, you sold it for 10, you made $5. Okay. Yeah. That's just nominally what you make. You then also have to look at the time value of money. I'm not going to go into that inflation concepts and all of that, and then the tax aspect. So I'm not even going to touch those things. So we're just going to talk in just nominal terms. So which again is just like the actual numbers, nominal number terms, not real terms, which is where it would be adjusted for inflation. So what did $5 buy you 20 years ago versus now? A heck of a lot more than it just does now. I mean, you look at as a child, I even noticed inflation, became very acutely aware of it because I used to be able to go to the corner store with $1 and buy some lollies. Then later and later, you're like, oh, I can't. I need like $5 or $2 or $5 from mum. Going to if you're in Brisbane and you go to the Ekka, you used to be able to get a $2 Birdie Beetle bag. These days, I think you can still get it, but there's significantly less in there. And you can't really get away with, some of the show bags are horrendous now. They're, upwards of $35, $40. Anyway, I digress. So when we look at income and capital, so we're not just talking about what you bought it for, what you sold it for. If it's something that pays dividends or some sort of an income return, you have to factor that in as well. If you have reinvested the income and sort of worked on the compounding concept, then that can be factored into the buy and sell. But if you've taken that income out during the period, then you also need to factor that in. So it's then also looking at what do you invest in and what are you wanting? Do you want purely capital growth and you don't really care about the income side? Or are you kind of approaching you're in your 50s, possibly, mid to late 50s, you're thinking about retirement, you want to make sure that you're investing in things that also pay an income. Because when you retire, you can't just live off capital where you have to keep selling things in order to survive. You want to be able to have income from your investments so that you actually have money to live. So hopefully you'll have paid off your home, so you at least have a home to live in that you don't have to pay anything extra for, but you still need groceries, transport, phones, electricity, rates, repairs, insurances, holidays, gifts. Like there's so many other aspects to our life. Obviously, the scale of that will shrink a bit because, well, you don't have the same level of income as if you're, earning your salary or your business was running. But it's still something to consider when you're actually purchasing as well. And you can purchase individual stocks that have dividends built into them. Or you can then focus on ETFs, which is your exchange traded funds, which is a bundle of shares in that ETF. And you can have shares in there that pay dividends so that you are then entitled to a portion of those dividends and they get paid out. Most pay out quarterly, some pay monthly, some pay 6 monthly, some pay annually. It really depends on the company that's included or companies that are included in that ETF bundle. So just something to kind of keep in the back of your mind when you're making your decisions. But I'll go through some of that when I talk about what I invest in and why. So the next thing is your risk profile. And this is important to understand because we are all unique individuals. We all have different experiences, fears, filters, biases, lenses that we look through the world, expectations. There's so much that goes into it. And there are some things that you can sort of look at more numerically, like how old are you? When do you want to retire? So then how many years into retirement are you? But there's still personality things that come into that that you really need to understand yourself a bit more. I also often, when I have this conversation with clients, will be talking about things like, all right, so say for instance you invested in something, a share, a property, ETF, whatever it happens to be, and when you're investing in shares and ETFs, the pricing can be a bit more volatile. Property happens a bit slower, typically, not always, but typically. So say for instance you buy something and then you go and have a look at your portfolio a week later and it's gone down. How do you feel? Do you panic and sell? Or do you panic and hold? Or do you go, yeah, oh, stuff happens. I'll just, this is part of my strategy. I'll just keep on going. Um, or do you just not look? So it's then if you do look, I remember having a lady come up to me at an event once and she said, oh, I'm really, really, really stressed because I keep looking at my superannuation balance and it keeps going down. And I'm like, okay, so how often do you look at your superannuation balance? She says, oh, every day. I said, okay. One thing I'd probably suggest trying is don't look every day. Just maybe look to start with once a month and maybe push that out to once a quarter. And because I said to her, I said, do you need that money right now? And she's like, well, no. And I said, well, then just, things will change. Life, so much can happen in a day or a week, really. So you can look too much sometimes. Having data is great, but when it's overused, it can make us nuts. I've been there, trust me. So your risk profile needs to look at a whole number of things and also needs to look at like liquidity, like how easy it is for you to sell something in order to get cash. And this is where we flow on then into diversification, which is keeping your risk profile in mind. How diversified do you want to be? Like living in Australia, there's a real push on property. It's been the sort of a large portion of the population has been able to build wealth through property. Whether that's going to continue to be the case, considering the property prices are increasing quite dramatically, and our interest rates are still, relatively low comparative to, when I was growing up. I still remember interest rates being up at around the 16, 18% mark. And now they hit 5% and people start panicking. It's like, well, our cost of living obviously has gone up as well, and salaries generally haven't kept up either. So there are other circumstances that contribute to that feeling. But understanding that having a portfolio or having your portfolio, which we'll still talk about, as just property, that's not diversified. And quite often, people who buy property will buy property in areas that they know, which often means that you've got multiple properties in the same suburb or next neighboring suburbs. So that is definitely not diversification. So understanding what diversification actually means and then how to use that concept to build your portfolio is actually becomes quite important. So just sort of an example in terms of like me, I have chosen not to go down the path of property investing like that. I invest through like ETFs and things like that, but as like direct holding, I don't want the hassle. I don't want and to a certain extent, there's a part of me that's like, I want people to have the opportunity to buy a home. I have one. I don't need more than one. If I rent, I mean, yes, then there's no rental stock and so forth. So we do need investors who rent out too. So everyone's perspective has validity, provided they're doing it for the right reasons and it serves the purpose of what their lifestyle needs as well, and they're not putting themselves under undue pressure. I've just been around property as an investment through my parents and my grandparents, and oh my goodness, it was a big headache. And even making a return on it was actually quite hard. I can make a much more decent return in the share market than in property. The only advantage property really gives you is the debt leverage component, where you borrow money to service the asset and you buy it earlier than if you would have to have saved that money up. So that's really the main area that gives property its advantage. There are at the moment some tax benefits to it as well in the form of negative gearing. And you can use equity to purchase properties as well, provided you've got enough. Um, That, however, changes if you start to use self-managed super funds. You can't do that anymore, but then there's other benefits too. Like, anyway, so this is where you do need to consult professionals before you do something so that you can set things up in the correct structure. So you can talk to a financial advisor, an accountant, and a lawyer and make sure they're all talking together because each one of them will be looking at something from a different perspective. And you don't want to have a really great structure, but then find out that it's not tax effective or make a decision that looks sort of good on paper in terms of having a financial plan, but again, it's not tax effective and the structure's not right. Or the lawyer's like, oh, that's too complex. You don't need that structure. So it's they all have to be working together. So it's important to understand that, and it is really important to do all of that before you launch into something. Especially if you've got some family dynamics and complexity there, you may need to look at trust structure. From a estate planning, you might need to look at a testamentary trust. So you need to make sure that you're talking to an estate lawyer when you're making those sorts of decisions. So there are still things that you need to consider, but I really don't want those things to like completely hamstring you. Yeah, from actually doing something. Therefore, more like the bigger structural type things, but you can still start doing some basic investing, even at a micro level to start with, just to get yourself going until you build up enough momentum and confidence and, to be honest, capital to be able to actually do something more with it. And you can move assets sometimes, depending on how they're set up in the first place. Again, you need to seek advice on that to make sure it suits your circumstances. So that's to think about with diversification. So don't just go, oh, I'm familiar with property. I'm just going to do property. Have a look at other options as well, just to diversify. Depending on what happens, then at least you're covered. If one market goes down, you've got something somewhere else. And just start to consider that. So then your portfolio is where you put everything in terms of, the old-fashioned terms, which are still quite valid, really, are looking at something that's defensive, something that protects your money, and then investments that grow your money. So you've got like defensive versus growth. There's stuff in the middle now as well. Like there's, anyway, but yeah, but largely they're still the main two kind of buckets. I've always kept my portfolio at a 70% growth, 30% defensive. And that's even quite conservative for someone, I've had that perspective. I only really started investing in my late 20s. So to have that kind of in my 30s, I could have probably gone a little bit more growth oriented. But I've kept that. I'm still at that 70/30, but I'm going to be, approaching my 50s in the next few years, and that might start to become 60/40, where I'm, a bit more on the defensive side than growth. It really sort of depends what's going on in the world, what I've got in my portfolio at that given moment, and how my profile kind of, because we do change a little bit. I've gotten a bit more comfortable with risk as I've gotten older, probably because there's some confidence that's grown and knowledge and experience as well. So your risk profile can change. So that's the other thing to consider too. So in terms of portfolio, when we talk about defensive, so the things that I've got my money in is just some high interest bank accounts. And some of them are where you have certain conditions that you need to meet. So like putting in a certain amount each month or having the balance higher at the end of the month than it was at the beginning and little things like that. I try and find a financial institution that has limited conditions. I was with one that had started to creep in more and more conditions when it got to the point where it was too many. So I switched to one that was simpler. And even that one has started to creep in some more conditions. So I may have to rethink that one as well. So you do have to kind of consider what is it that you want to achieve. So I have money sitting in those sorts of accounts. I run my money pie in my high interest bank account as well. So I've got like a number of accounts in there. So I found a bank that, and if you've got a mortgage still, if you've got a financial institution, and a lot of them do this now, if you've got an offset account, you can have multiple offsets. So you can have your savings sitting in there, but still offsetting the interest of your loan. So you just need to check with your the holder of your loan if they're able to do that. And if not, could chat to a mortgage broker about changing because it is a good way to manage your money having it separated because then you know what it's for. But it's still actually doing something useful, as in reducing the interest payments. But then I've also got things in sort of like I've just opened up an account with Term Plus, which they do sort of private credit, and it's more income, and they have what they're targeting is I think it's about 3% above whatever the current cash rate is. So the official cash rate plus three, I think it's 3%. As another way to kind of diversify the cash side of things. There's still a bit more risk in that than just having it in a bank account. However, again, like I said, my risk profile has developed a bit over the years, so I'm comfortable to do that with a portion of my portfolio. Then comes the growth side, and this is where you can really overthink it. I subscribed to the Barefoot Investor when he was still running his membership years ago, and I'd already done a lot of my own research, and had come up with three ETFs that I was in, and I was really excited when he came out with his final kind of portfolio, and two of the ETFs that I was in, he had on his list, and I was like, yes, I got two out of the three right, and the third one was very similar. It was just a different like ticker or like a different code. So I'm a big Vanguard fan. I like their approach and their sort of customer centricity and how they've kept their fees. Like they came in to disrupt the market essentially to try and make investing cheaper and a lot more acceptable or accessible. That's the word I'm looking for the individual. So it wasn't all just like the big bankers at the heavy end of town, reaping in all of these commissions and everything. Like they were like, you know what, we're going to let you have access to all of this, and we're only going to charge you like 0.25%. I remember when I had a financial planner when I first started out because I had no idea what I was doing at the time. And I was paying about 3.2% in fees. When I think back to that, I was like, oh my gosh, the level that that compounds and eats away into your investments. Like I was paying fees upon fees upon fees, literally. And I remember confronting this financial planner. I was like, I'm sorry, but what are you actually doing for that money? Like you just like chucked me in these funds. Those funds can go up or down. You still get paid based on the balance that's in there. So, if they go down, you still get paid. They go up, you get paid more. But you still get paid regardless, and you don't actually do anything. So I remember the look on his face, just kind of like, oh my gosh, I just like hit him in the chest, thinking, oh, who's the system set? What's the system set out for? And then that's really what set me on my path. So I now just do it myself. I mean, you can, of course. I mean, and there's access. There's certain investment setups that financial planners can set up for you that are not going to charge you that level of fees. That can hold your hand through the process. And you just have to find the right planners or advisors. But there's still validity to that. I just didn't have a great experience with mine. And so over time, what's happened is I have a tendency to get bored with things that are the same. I don't even like driving the same route to things all the time. So even when I drive my daughter to school, sometimes I'll turn right at an intersection and sometimes I'll turn left because I've turned right for the last week and now I want to turn left. So I'm just precursoring that with a little bit of where my brain goes, and you don't need to add this level of complexity to it. You could just stick with the three ETFs. So one was an Australian one. So one of the most popular Australian ETFs is VAS, which is Vanguard Australian Shares. So it invests in Australian companies. And I'm just looking at the tickers to make sure I get the right ones. And then the other one was VEU, which is all of the world except the US. Um, I'm also quite partial to another one called VHY, which is high yield, which means it pays a lot of dividends, or not a lot, but it's higher dividend yields as well. So I quite like that one. So I added that one in after a while too, because I liked it. And then the other one was VTS, which is just the US. So that was VAS, VEU, and VTS were the three that I'm in. And then I've also got some that are just Europe. So I have VEQ as well. And then, like I said, I've added a few other ones in there too over time because like, oh, that sounds really interesting. There's one that's got innovation in there. So it's like, oh, I want to invest in things that are a bit more innovative. And then there's others that invest just in the Asian market because I see some growth possibilities there. And then there's others, yeah. So there's a few more that I've added because I got a little bit bored with just doing the same ones over and over. Not for any reason. They were all still working well. They still paid dividends, they were growing. I just wanted to like do something extra. And the other great thing about Vanguard is I have an automatic investment possibility so that you can set up a direct debit every month, whatever day of the month you want. It'll automatically take it in there. You tell them which ETFs you want to buy and in what kind of percentage. So I have the same amount going every month, tell it to buy these three ETFs. It just keeps doing it on. And then you can also request dividend reinvestment as well, so that every time it pays a dividend, it just goes back into the pot to buy more of the same thing. So it really simplifies it. But like I said, with simplification for me came boredom. So that's why I started adding a few more in there. So now I'm like, oh, now I can track a few more. So I have more than the three that I initially started out with. Now I've got about, I think about eight. So, but like I said, you don't have to do that. I would just suggest to get exposure to the whole world is Australia, America or US, and then rest of world. There may be a couple of double ups in there potentially, but not really, but no, not much. But then at least you get sort of exposure to the top companies. And this is because it's an ETF and it's a bundle, it's going to take whomever is the biggest at that time. So the makeup may change if any of that list changes, but you still stay invested in that. And you don't have to pick individual stocks. I started to do, well, I went down the path of learning how to do that. And then just looking at candlestick charts and all this stuff, so I was just like, this, no. And then I thought, oh, maybe I should just hire a broker to help me with that. And I was like, no, if I don't really understand it, I don't want to invest in it. Whereas I understand ETFs and I understand what I'm investing in and how to access it. And the platforms themselves are make it easier too. And then I've got now I've added in beta shares. I actually really like their app. It's very easy to use. I can get access to more ETFs than I actually can on the Vanguard, including Vanguard ones on there. There's actually one Vanguard one that I can't access on the Vanguard platform, but I can on the beta shares one, which is VTS. And they don't charge fees either. So so I now have two trading, well, I actually have three trading platforms because when I first started, I was using Bell Direct. And I just found that a little bit clunky after a while for me. Again, a lot of these things, there's different providers out there. And same with the micro investing. My account is with Raise, because they're the ones they were like the incumbents into the market or the first ones in the market. They started out being called Acorns and I joined them then. So that's the early adopter. And then now there's others like there's Perla, which is really good. In Raise, I can do roundups. And I can also have a child sub account. So I have a child sub account for my daughter and invest regularly in there. So there's like this other little, and there's even an avatar. My daughter looked at it once. She's like, Mama, I don't look like that. I was like, it's just an avatar. And then we had to have a whole discussion about what avatars mean. Anyway, but you can do that. And you can do that with a few different apps as well. I'm pretty sure Perla does that too. They're really focusing on children and helping children understand how to invest. And then the danger then though becomes is that you don't want them to look at it too regularly and become like traders unless you're comfortable with them becoming traders. Investors is where you buy and hold. I was literally just listening to a podcast talking about Warren Buffett and his sort of methodology and how he's one of the greatest investors long term of all time. And he buys and holds. He rarely sells, mainly just buys to hold. That's my philosophy as well. I just buy and hold. I just keep buying little by little. And I'm not talking about huge chunks. Like I'm not buying, hundreds of thousands of dollars or even tens of thousands of dollars in one go. I have like the micro investing, I literally add $10 a month on top of the roundups. And then I have $50 a month that goes into my daughter's. And then I have another micro investing account that does fixed interest, which has another $50 a month that goes in there. And little by little, the stuff just all kind of builds up without you even noticing. And that is the really important part, is to make this as painless or as stress-free as possible and to just do it. Like literally that micro investing account that I was an early adopter in now has, I think, just over 12 or close to 12. It fluctuates a little bit, around $12,000. I've done seemingly nothing to build that. And now it's there, which is, it'll just keep ticking away. My daughter's now has about $900 in it. So like, and that's on top of the 12. So it's just, and I've had hers in there now for maybe 18 months. So it's just there's no excuse is my very direct way of saying just get started. Um, and then have a look at some of these, like have a look through sort of some of the product statements and things and the returns. And of course, past returns is no guarantee of future returns, and investments by nature are volatile and a bit riskier. I'm seeing a lot of volatility at the moment. There's a lot going on in the world, which is driving that. So I think that's just going to be the way we're going to live now. We've just got to get used to it. So yeah, just keep doing it. And that's where the concept of timing the market versus time in the market becomes really important. So over time, that like dollar cost averaging is what they call it, has proven to outperform active timing the market. Time and again. If you look at charts over time, just regularly, there's actually an entire book that I've got called Keep Buying. And he has a lot of charts, which I have to admit, after a while, I started to flick past because I was going, yep, I get it. I get it. Yep, I get it. Yep. So many more. So, right, more, another chart. Wow, more data. Okay. But essentially, what he's saying is that over time, just consistently buying regularly over years and years and years and not trying to time the market produced a better result. And to be honest, it's a more peaceful way of operating too, rather than if you'd known, because of course we never do, what the dip is and buying in the dip. So even with hindsight, it was still not enough to meet the returns of dollar cost averaging or just consistently buying. So it's a good lesson, I suppose, to take heed of, and it's certainly one that I have, and that's my approach. So I hope that has helped clarify a little bit. I'll just sort of round all that back up again. So looking at your income versus capital returns, just to keep that in mind. Also keep in mind what your risk profile is and what your appetite is for things fluctuating. And then how diversified you either currently are or would like to be, and then as a result, what's in your portfolio that's going to help protect some money, but then also grow it so that you don't have everything in growth or everything in protected. Make sure that there's some level of balance in that, whether it's 80-20, 30-70, 60-40, 50-50, and then it will shift and adjust as you get older too. And there are portfolios now that actually allow that adjustment, especially in the superannuation space. And then I went through a number of different ETFs that I'm in, and what I do in terms of micro investing as well. And then that timing, just consistently, little by little, doesn't have to be huge amounts. Just keep it going over time, and then you'll start to see results. But it won't happen. What's that saying? It won't happen overnight, but it will happen. And that's yeah, like everything, there's nothing absolutely certain in our futures, but one thing is for certain is that if we do nothing, then you won't have, yeah, if you don't invest at all, then you won't have any investments in the future. That that part's it. So yeah, so if you have any questions, please reach out. If there's anything in particular you'd like me to go into more detail in on an episode, then let me know and I'm happy to do that. But I hope that's given you some food for thought and maybe a little bit more of a nudge or confidence or information to be able to work forward with to actually take action. Okay. Have a wonderful week, and I will catch you next episode.